Welcome, Savvy Investors, to the Savvy Investor YouTube channel. And again, we got another great live training session ahead of you. This is going to be awesome. Really looking forward to this. We've got an amazing topic of discussion, which I know is pretty sensitive up here in Canada. And we've got an individual coming from down south to kind of join us and talk a little bit about this. And this is specifically pertaining to private lending or in the private lending space. And for those of you that have been always wanting to get into private lending, or you're currently in the private lending space, do me a small favor in the chat, just say me, because I want to know who is in the space that's joining us today or watching the recording as well. Okay, so for many of us investors, this can be a topic that feels a little bit like maybe intimidating, maybe a little confusing, especially in this current marketplace. And in some cases, for a lot of private lenders out there, maybe even a little bit concerning, especially if you are private lenders that are providing capital out there. There's capital that's kind of sitting out there right at the moment. Which is one of the reasons why I brought in the big guns. The big guns today. Honored to have our guest speaker, Beth Johnson, joining us, who is a Bigger Pockets author, speaker, and authority when it comes to private lending. And the best part, to be honest, she's actually just in my backyard in Washington. So it's just great. We get to enjoy the really miserable rain together. I don't know if it's actually raining back there, but I know here it's just been unbelievable. So with that being said, this is actually an opportunity to learn more about her journey when it comes to private lending, learning the do's and don'ts of this business as well, and also getting a chance to learn how she mitigates risk with her private lending company during uncertain times. Wait until you hear the amount of capital that she's actually putting out there in the private lending space. It's just quite shocking. So it's amazing to kind of get her breadth of knowledge to kind of share with our savvy investor community. So again, looking forward to a great discussion. Very excited to have Beth join us and share some of her words of wisdom with our savvy investor community. So before we get started, just a friendly reminder to everybody that this is a YouTube live. So if you haven't had the opportunity to do so yet, please do me a small little favor, hit that subscribe button, hit that notification bell, and it'll keep you notified of any upcoming sessions ahead, number one. And secondly, I always love to keep our sessions very, very engaging. So please, guys, do me a small little favor. Ask your questions, put your comments in there. This is the best way we all kind of learn together. So with that being said, we're going to start kind of moving things on, but I've got one other's last announcement here, and very, very excited about this one. And more importantly, let's get a chance to introduce our wonderful guest, Beth Johnson. How you doing, Beth? I'm going to have to unmute you first. How are you doing, Beth? How are you?
I'm doing really well, thank you. And it's actually sunny here in Seattle, so hate to break it to you.
Oh, that's why I obviously need to go, because the rain here the last few weeks has been, or the last few days has been unbelievable. So anyway,
it's
different
fleeting.
topic.
I'll be like you soon. So
very good. So you know what, Beth, like I was telling you earlier before we jumped on the call, I got a chance to kind of follow you on your social media and, you know, amazing stuff that you're obviously producing. But for a lot of people, this is the first time they get a chance to know who you are and what you do. So maybe if you wouldn't mind sharing a little bit about, just do a little bit of introduction of yourself, and so we can let our savvy investors know who our guest speaker is in a little more detail.
sure. So my name is Beth Johnson. I'm from just outside of Seattle, Washington. My husband and I started a private lending business almost a decade ago. And like many other private lenders, we just kind of stumbled into it by accident, wasn't really planning on it becoming a full-fledged business. But once you start saying that you have money in a real estate investing meetup, you sort of become the most popular person in the room. So we have a company down here in Washington. It's called Flynn Family Lending. We're known for providing some really creative financing solutions for real estate investors to help them get across the finish line, where traditional lenders or even bridge lenders, hard money lenders might not be able to fit the bill. And that's been particularly important in the last 2 to 3 years since COVID, since capital is tight, lending guidelines have been more constricted. And so our business has been blossoming year over year, to the point where we actually started a private debt fund as well. It's called Lend to Live. It's named after the book I published on Bigger Pockets, which was completely by accident as well. I don't think that anything I've done so far to date has been designed or planned and executed that way. Though I tried in vain in my 20s and 30s. I finally gave up in my 40s, I think. So, have a private money lending business with my husband, both rewarding and has a lot of challenges in and of itself when you spend 23 hours a day with your husband. But we've really enjoyed the process. We've been able to really provide some great opportunities to real estate investors to help them grow their portfolio. And I really wanted to share that experience with other would-be private lenders, because when we got started, there really wasn't a guide out there to share
Yeah.
how to do it. And so I was really kind of left to my own devices, and you don't know you have a problem until you do. And then you're left to figure out, how do you work that out? How do you make it work in your favor? And so all of these lessons learned have been boiled down into 300 pages to share how do you really successfully and safely find and fund a private money loan, and create a nice passive income for yourself, but really focused on preservation of capital first and foremost. And so that was the impetus of the book. And again, none of this was planned, but I'm happy to share this, both in the US as well as with Canada too.
Love it. Thank you so very much. And again, this is just so cool. Like, what's kind of interesting is, there's so many, like, back now, I've been doing this for about over 20 years, and there was just not as much information as there is today. But one of the things that I've learned is, or sorry, one of the things that I've kind of evolved into is, I'm more focused in real estate investing, and you tend to hear, people buying multifamily properties, single family properties, or in Burr. I'm interested in learning more about, what got you into private lending, regardless if it's accidentally or not, versus another strategy, like be it real estate in general. And maybe that's actually part two to the question. Do you do real estate investing as well, or is private lending your main focus?
Well, private lending is our main focus, but I'll say that the impetus to all this was drinking wine on a boat with my now husband. But going back beyond that, my parents were raising a family of five. My dad was a woodshop teacher, and he knew he wasn't going to get rich that way. So he invested in real
Right.
estate on the side. As a kid, I spent a lot of time doing that as a side hustle, kind of seeing him execute his projects, whether he kept them as rentals or flipped them. He had, lots of time in the summer and weekends to do so. And so I knew that real estate was going to be a part of my life journey. I just didn't know how. And so
Mm,
in the early 2000s was when I got started. I did a handful of live-in flips, a couple of flips when '08 hit. I was fortunate enough to get out of them unscathed, which was great.
yeah. Lucky.
Lost a lot of potential equity in them, but I didn't lose any principal. And so I think that was a kind of a good win for someone in their mid 20s at the time. And then I found myself divorced with two kids. They were both under the age of five. Flipping wasn't really in the books for me. I mean, I was just
Mm,
kind of treading water and restarting. I did all of the acquisitions and the design. My ex-husband did a lot of the handyman work. He was very skilled as a craftsman. And so I just didn't really want to get back into active investing when I was taking care of two kids by myself. And so
mm,
when I got set up on a blind date with my husband, Matt, we just bonded over real estate. He grew up in real estate. He had been in mortgage. He had flipped and wholesaled houses. And so he wanted to get back into private lending. He had done it prior to '08, and he wanted to start it up again. And I thought, well, I have a marketing and operations background. Maybe I can earn a little side money and spend more time with you, and we'll just get it started that way. I'll build you a website, I'll create some forms for you. And that's how it was born. Really did not think that I would end up being the managing partner of a business that funds, eight figures annually, or write a book, no less. But it just kind of transpired all by accident. But I do love private lending more because it really is a more passive way for me to invest. I
mm.
started personally with my own self-directed IRA. I had a legacy plan from a previous employer, and I never invested in stocks. I mean, I had some tips from a coworker and I just invested it that way. But I really didn't know the first thing about it, but I knew real estate. So I thought, well, if
Right.
I lend my money out there, then that was a good way to create some healthy returns and build up my nest egg that I sort of lost when I got divorced.
Mm. Interesting. Very interesting story. So didn't want to be so hands on, fixing toilets or replacing toilets or any of that stuff. And you thought this is another passive way that was another aspect of real estate investing that you enjoyed. So very, very cool. Love it. Love it. So, forget a lot of people right now, Beth, that there's a lot of individuals that are maybe considering this as an investment strategy, but in some cases they're kind of being held back a little bit. And it's just maybe the perception that private lending is maybe a little bit more higher risk than maybe, I don't know. And again, this is a perception, maybe than real estate investing. So maybe you can share some of your insights of, maybe key risks private lenders should maybe be aware of. So if somebody's looking to get in this space, what are some of the things that they should be aware of before they jump in?
Sure. I mean, I think I'll say that I was probably in that same camp early on. I thought there
Yeah.
was a lot of perceived risk, especially doing second lien positions behind bank loans or commercial loans. That was sort of our sweet spot in lending smaller amounts of money when we first started. And of course, I had all this headwinds from the 2008 crash, where there was a lot of mortgage fraud coupled with the recession. And so junior lien positions really kind of took a beating in terms of their perception. And so I was in that same camp. I will say that, over the last decade doing this, private money lending is a little bit perennial. I thought,
Hmm.
we're just going to ride this wave. I didn't want to turn down opportunity early on. We were super overwhelmed. It was just the two of us for several years. But that end never came, and it still
Hmm.
hasn't. I thought when COVID hit, just like every other small business owner, we'll be a little screwed. Maybe the volume will slow down. In fact, it has been quite the opposite.
Hmm.
In a down economy, when the cycle starts turning down, which it took 12 years in the States to do, I'm actually a fan favorite out there. Why?
Hmm.
Banks are tightening their credit policies. Some hard money lenders are faltering. They're not able to provide the loans that they used to because their source of capital is tied to Wall Street and the banks also. So they are having a liquidity challenge, just like the banks and financial institutions are. So real estate investors who are sitting on a stack of cash because maybe in '08 they learned their lesson and they were keeping a lot of reserves, so they have this dry powder on the side. They need people like us. They have capital. They're just waiting for that time to, jump back into the market. They've probably been waiting on the sidelines for the last, I don't know, 12 to 18 months, like myself. And they want to get into something, and private lenders are the way to fit that bill.
Yeah.
And so I've really naively thought that at some point in time, private lending would curve down, but the opportunities are far and wide, and I'm allowed to pick whatever deal I want to. So there's a lot of really safe opportunities for me to lend. And certainly a lot of them that I turn down. Our conversion rate in our business is probably well below 20%. So for every 10 calls, I might take applications for two. I might fund one of them is generally
Wow.
the rule of thumb how it goes. But that means I get the pick of the litter. I can take it as conservative as I want. I can drive the terms in the manner that I want. It all is up to my own choosing within legal parameters, right? There's definitely some legal considerations in the US at the federal level as well as at the state level, and in Canada at the federal level as well, regarding usury and licensing and other type of regulatory considerations. But in the states, private lending is really deregulated, and so
Hmm.
it's a little bit like the wild west. I can charge what I want, what the market will bear, so long as I am very considerate of usury limitations. In my state of Washington, it's only 12%, which is seems like quite a bit actually, but I figured out that the federal rate in Canada is up to 60%, which is quite large. And so I do have a lot of control over the type of assets, the type of borrowers, the type of projects that I want to lend on that will make me sleep well at night, right? Because this is supposed to be a passive investment. I don't want to fix toilets. I don't want to deal with general contractors. I just want to make sure that I get that mailbox money in. And the moment it doesn't, then I might need to step in. But by far and large, if you pick the right loan, most of them will perform month after month. And you just receive that check or that ACH deposit into your account each month, and away you
Hmm.
go.
Cool. Awesome. Awesome stuff. I just put a question into the chat, guys, for our Canadian folks so Beth can see what's going on. Because you're saying about 12%, right, Beth? Is that what you're saying?
12% is the usury rate in Washington. It's much lower in some states. It can be higher. Some states don't have any usury limitation at all. And so usury really limits and caps the amount of interest, including certain fees and including certain penalties and charges, really more for consumer protection. So when you're doing private lending, particularly from a private lender to a real estate investor, it's generally a business or commercial loan, in terms of the loan purpose, the use of funds. So most of the time, usury doesn't really take place in a private loan that is business purpose, but it can. And so that's always a consideration to make sure that we're lending on properties that are non-owner occupied, to make sure that we're aware and familiar with what homestead laws and rights are for that particular borrower should they move into it. So usury and things like that, you really have to make sure that you're aware of them. And I've partnered with a real estate attorney locally here that is very adept at not only understanding usury and real estate law, but he also helps me draft up my contracts and provides us some advisory support as well when we need it.
Yeah, awesome. Really great stuff. Now, I want to kind of elaborate on a couple things you did highlight specifically, and I would imagine across the board, you guys are seeing the same thing. Now, here in Canada, there's a lot of different markets right now that we're seeing prices starting to drop in some of the bigger markets, like Vancouver, as well as even in Toronto, big markets. They were just in an absolute boom time for decades, really, to be honest with you. But now this is, they're seeing a cycle that they've never seen before. And in fact, I even highlight this a lot, is you've got a couple generations that have never seen a decline in prices at all in 20 years. And so this is new for everybody, right? For them. And in some cases, maybe even some times of desperation, because they assume that prices are going to continue to go up. They want to refinance, pull a lot of capital out here. And I guess the one thing that you did bring up, and I wanted to kind of elaborate to see what you have to say, is you get to pick and choose the types of deals that you want. Are you finding that in this type of environment right now that you are maybe turning down more deals than you were before? Or maybe you could just highlight, has things changed in the last couple of years just with some of the interest rate hikes? And then the
It
second part
has.
to that question is minimizing risk in this situation, because I think a lot of people are getting, like private lenders, they're probably getting their doors knocked on quite a bit. And they're saying, hey, we need some capital for whatever. What are you doing to mitigate some of that risk, just to be extra cautionary in regards to making sure that this deal still makes sense?
Sure. I mean, I think because I'm older and had gone through '08, I mean, anyone that's 35 and under, no knock on them, but they've never gone through a
True.
downturn. And so
Yeah.
absolutely the increase in Fed rate hikes has shocked a lot of younger investors. They still are talking about the assumption that rates will go down. And I have to give them some sort of counsel that in the States in the last 50 years, they've always hovered around the 7% mark. So they may go down, but you're certainly not going to see this essential free capital that we saw flowing, at least in our markets, anytime soon.
Yeah,
So
I
when
agree.
the first Fed rate hike actually happened, when Russia invaded the Ukraine, I kind of saw the writing on the wall. And because of course we've been doing this for a while, if I look at comps throughout the spring of 2022 for recent sales, well, a lot of single family residences were locked into rates. So about the time that they started closing, even though the rates had increased, they were still locked in. So sales in March, April, they weren't indicative of where the market was going to be, because there's a lag in interest rates, right? So I was manually adjusting down some of the valuations, either as is valuations, or I might knock the ARV or the after repair value down by 5 or 10%, depending on the market.
Yeah.
It made a lot of borrowers upset, but it was something that we needed to do to ensure that we were well protected. Because the reality is it's not really what it will sell for right then and there. It's what it's going to sell for when they're done with their project. And if I'm extending 10-month terms, which is pretty average for what we're doing, then I need to forecast to the best of my abilities, what is that return going to be for them 10 months from now? And
Yeah.
so throughout the year last year, I was knocking down valuations. Even if my LTV was a little bit higher and I was wrong, well, they're just going to have a larger spread on it. And so that was good for them. It was good for us. And it created a really healthy equity buffer to make sure
Mm,
that we had a lot of room in there for longer timelines to complete, longer days on market, lower valuations, lower appraised price valuations as well. we had a lot of factors that were really out of a borrower's control. We were mitigating that risk by ensuring that there was a healthy equity buffer of about 30% to
Mhm.
40% in many cases. I like to stay, years ago it was 70% loan to value or better. As soon as the Fed rate hikes started happening, I started trying to do more like 60 to 65% loan to value or better. The rationale behind that is that if I have that extra 5% in there, if they can't sell it and they need to go and try and refinance it out and they just don't have the cash reserves required to refinance out, that 5% equity between 65 and 70 could still get them across the finish line in terms of shoring up their capital reserves by equity as opposed to cash on hand. Not every lender would allow for that, but I did know some that would. Quite a few DSCR lenders or debt service coverage, like long-term rental loan programs, would offer that. And so it was is a measure of protection for us as lenders to ensure that they had a proper exit, because I'm not successful as a lender if the borrower isn't successful. If they don't make a profit, more than likely I'm probably not either. So we need to ensure that they have a really solid exit strategy, and then a plan
Yeah.
B, and then a plan C. And to the plan C for us, the unspoken one was always, if they can't get refinanced, if they can't sell or won't sell, can I kick the can down the road just a little bit more and refinance them out with another hard money lender that will go up to 80% loan to value? I can. They can. And so I had another exit strategy that I'm not going to force upon a borrower unless I absolutely had to. And that doesn't
Yeah.
happen very often, but it's a nice protection measure to ensure that I have a number of different ways to get out of this loan when I need to.
Very good. And I hope everybody's listening to that. So, really just listen to what she's saying. Is Beth's highlighting, 60 to 65% loan to value, that extra cushion. What's plan A, B, and C? I thought that's just excellent. And I guess what would be those plans B and C? Is there some commonalities that you would tend to kind of see, Beth, in some of your deals that you're looking for in regards to clarity to multiple different exit strategies?
Sure. I mean, we get a lot of flippers coming to us. We generally like to use that rule of thumb out there, the 70-30 rule. I don't
Yeah.
know if that's evangelized much up in Canada, but you really want your total costs to be 70% of what your exit price is going to be. So you have at least a 30% profit margin on there. I have increased that a little bit more. So I'm trying to see whether or not the flipper does have a healthy cushion in there, because the last thing you want is for them to come to close. They severely overestimated what they thought they could put it on the market for. And now they
Mm,
have to come out of pocket cash to close just to sell the thing. And a
yeah.
lot of really experienced borrowers last year were commenting. I'm part of lots of Facebook groups locally here in Washington too. A lot of experienced volume flippers that had to come to close with tens of thousands of dollars to get it closed. Not every flipper has that capability. So I need
Yeah.
to make sure that they have the capability to get refinanced out. Whether that's conventionally, I will check their credit score. I'll make sure that they have some cash reserves to cover some contingencies. I might even go so far as to pre-qualify them with a lender colleague of mine that does the debt service coverage ratio loans. Those DSCR loans are great for 1 to 4 units. Some of the lenders that offer those will go up to 10 units. And so I'll pre-qual them to make sure that they'll have the DSCR needed in order to refinance out of it. So
Mm.
that's usually the plan A and the plan B. And of course, we've gotten a little bit more stricter here in the last 18 months for sure.
Awesome. Really good stuff, guys. I hope you guys are taking some notes. Some really good stuff here. Beth, maybe if you don't mind sharing, maybe you can highlight about what you and your husband do kind of for the due diligence process. You just highlighted you may be funding 1 out of every 10 deals. So you're turning down like 8 to 9 deals. Maybe you can just highlight some of the key things that you are doing. And has that changed much, even in the last year? Have you just enhanced it even further? Obviously, you've taken into account debt service, obviously, and just highlighting the deal. But a lot of people here in Canada, they get into private lending because they may not understand the real estate investing world. They just look at this as much more of an easier game to get into. It's again more passive. They don't have to do flips or any of this stuff. So they just kind of make the assumption that they're more focused on credibility of the borrower. So I'm interested to hear, do you spend a lot of time analyzing the deal and assessing the deal equally the same as the borrower itself?
I do. I mean, generally speaking, private lending should be more asset based, in my opinion. You definitely need to vet out the borrower. But as I mentioned before, last year, there were a lot of borrowers that got caught, with properties that were now devalued by up to 15 to 20%, no fault of their own. I mean, interest rates were sky high, and it just didn't pencil out the way their initial pro forma went. So no matter how much you underwrite that borrower, a GC walking off the job and creating scheduled delays, mechanic liens being put on your property. There are so many factors outside of their control. They could do everything right. And so for
Yeah,
me, properties don't disappoint me. People do. I say that a lot. I mean, people are the ones that disappoint me. So I just want to make sure that in all cases, I have that equity buffer protection, should worst case scenario hit and they're not able to perform. Because ultimately, when you have to foreclose on a property, I think everyone thinks, that's the scariest thing out there. And it is. I mean, nobody wants to take somebody's property away, right? That's just bad mojo. But if I have
yeah.
to, how do I make sure that I'm protecting my principal? If I have to engage a legal team to draw up the paperwork to file charges against them, because we're a judicial state. So I'd have to file a notice of default, file what we call as a notice of trustee sale, which is essentially a foreclosure process. I want to be able to make sure that I recoup my legal fees, my default interest, my late fees. And so that equity buffer is what will protect you in all scenarios. So my husband and I place a lot of emphasis on the property and the project itself. It either pencils out or it doesn't. We have shored up our projects and our loans, oftentimes by adding a second piece of collateral, because an investor
Mm,
doesn't want to lose
good.
one property, let alone two, right? And so oftentimes they have like a rental sitting on the side that's cash flowing. They have a low interest bearing rate loan on there in first position, and a lot of equity that they've built up over time. Well, if I put a second lien position on that rental and then help them acquire this new property, now all of a sudden I have two properties protecting me and an additional amount of value out of both properties that are protecting my loan, my principal amount.
Perfect. Love it. Love it. Love it. One of the questions that I kind of saw pop up on Instagram for me is what are some of the red flags that kind of stick out when maybe it's kind of in its earlier on that problems are occurring? Is there anything specific that starts to kind of like, you know what? I've seen this story before. Hopefully, it's not going to go down this road. And for some of us, that might be in that case right now. And they're just like, I'm getting, a spider sense tingling. You know what I mean? A good old Spider Man. What would be your spidey senses where maybe there's some red flags that I guess maybe for people just to be aware of, just based on your experience, Beth?
So let's start with the real obvious red flags. I met with a guy over coffee. He had some properties that he had equity in. He needed to refinance. He wanted to put us into second position. And he says, just give me a little bit of time. I'm working with my creditor and I'm trying to negotiate with a bank for a principal reduction. So right out of the gate, he comes and tells me that he is trying to get out of some of his obligation to pay back his creditor. Well, how well is he going to perform for me?
Mm,
And so that's a red flag. If we get pictures back on a property that somebody already that they already own, and they say they need some rehab funds on it, and I might see clothes in the closet, then I sort of have to press them and say, is this owner occupied? Because we only do loans on interest bearing or investment properties. We don't do it on people's primary residences. So I might see red flags around the property itself in terms of their occupancy. And so those are some pretty obvious things to look for. When they're coming to you and really pressed for time, they won't leave you alone and they keep asking, when are you going to get me terms? There's sometimes a fine line between a sense of urgency and desperation that I
mm,
find. And it's that desperation that I just really can't get involved with. Those seem to be, to me, very high maintenance borrowers that once the loan is in place, they may be, a lot to handle as well. And again, this is supposed to be a passive investment. I want to make sure that we can deploy our capital very safely. They go on about their business. I don't have to be a babysitter. And so that kind of desperation means to me that there's something underlying the circumstance that I don't know about. Maybe they're already defaulting on another loan. Maybe they have personal financial crises that they need to take care of and that they're not telling me. But I find that there's a lot of yellow flags that you can get out just from the nonverbal cues with somebody,
Yeah.
as opposed to what they're even telling you. Other things that I look for is a lack of true awareness and conservative nature when they approach a project. If they tell me they've never lost on a project, if they tell me high level numbers and I go see it and it's super overinflated, then I don't really think that they're overly grounded. If they tell me a bunch of numbers off the top of their head, or they say they haven't looked at it yet and they haven't really created that pro forma or rehab budget or talked with other professionals about what, what the mechanics of flipping that property might look like, then that might also be a bit of a yellow flag to me, because it means that they aren't really preparing up front for the project and they're not
Yeah.
prepared to talk with me. And so if they're not really putting their best foot forward when you fund the loan with them, imagine how they'll operate afterwards. That lack of
Yeah.
organization, the lack of firmness on their numbers and their budgets, that can all, translate into a really poorly run project after you lend
Yeah.
your money out. And that's just not something that I want to be a part of. So there's a lot
Yeah.
of cues in there that we're looking for that really are uh, not really something that they tell us, but it's something that we kind of see and sense, as you were saying.
Yeah. Got it. Yeah. It's just the spider senses. Let me ask you this is, and this is more in your business. I'm interested to see how you've evolved it because you've grown it to significant levels, obviously, over the years. And congratulations to your success. It's truly amazing. And I would imagine there's probably a lot of great learnings that come along with this in this business as well. Um, but maybe you can share, just kind of typical terms that you would normally go with. And then the second part to that question is, and when I say that, do you just do like 1 year, 2 year terms, 5 year terms, 10 year terms? Maybe you can share that part. And then the second part is, do you feel it's important to maybe have kind of a property segment avatar, like a specific type of investment or a typical investment that you just try to stay true to, be it like a multifamily burr or something like that? And do you think that's important for private lenders to be more niche in regards to where they're private lending? So maybe just those couple questions based on your
Sure.
experience.
I'll touch on that one first. And I absolutely think that it's important. When I coach other private money lenders and how to get started in the business and find that first loan, I really focus on making sure that they understand what their comfort zone is. A lot of private lenders tend to start out as active investors. So they may have a sweet spot. Maybe they were a flipper that is now converting over. Maybe they were a landlord and they had some small multifamily. Stay in the space that you know how to underwrite. I
Yeah.
have commercial brokers that really understand the commercial space very well, whether it's multifamily, mixed use, or office. They know that because that was their trade. And so that's probably the place that they're going to start in. For my husband and I, because we're such a small team, we do all asset classes just to create that diversification in our portfolio. But we really do have a sweet spot around residential, small multifamily, or single family homes. I like to stay clear of some of the larger asset classes that generally are higher loan amounts too. Industrial, commercial, retail, strip malls, some things like that, which can give me a little bit of heartburn. I just have to work a little harder at it, to be honest with you. So, your cost per hour is going to be much easier if you kind of stay within the same framework. And so in our book, we're always advising that if you really don't know anything about real estate, which some private lenders don't, stick with the fix and flip or the buy and hold investor, and stick with the single
Yeah.
family residence, because most people have lived in single family homes, whether they rent or whether they own. You can become familiar in your market. You know what areas are good, you know what areas are bad, what neighborhoods
Yeah.
to avoid, and you know what the average price per property is, or what the average rents are. So it's a good
Yeah.
place to start, I think, for the novice private investor.
Yeah, I agree. But I don't think it also, I think for a lot of private lenders, they should really understand the business as well. Like they should really understand doing analysis of or the ability to analyze deals properly. Because I see a lot of people just going in fresh. They maybe gone to, I don't know, a training course or something like that. And that's their starting ground, Beth. And so for a lot of people, this is like, well, I've got $100,000. I'm ready to do a private lend. But the one thing they don't know is they don't know real estate investing. I don't know if you have that if you've seen that experience in where you are. but here in Canada, it is very prominent that a lot of people just don't know real estate investing. They've got capital to invest, and they tend to trust here instead of kind of this. And
Absolutely.
and I guess that's maybe a question is what's the importance of maybe taking some time to learn, analyzing deals, looking at your markets, and you should know your numbers equally, if not better than your the person that's lending the money, that's asking for the money, if you understand what I'm saying.
Yeah, absolutely. I mean, taking the time to really understand the legalities of private lending, understand
Totally.
how you underwrite those deals, is paramount to a private lender's success. I find that private lenders getting started are really just so damn eager to get their money deployed
Yes.
that,
Yes.
I mean, yeah, some of it is trust, but some of it is just like FOMO, right? Like, I want to get it out there, I want to get it
Exactly
deployed.
it.
I trust everything they say, but I think it was a Reagan that said, trust but verify. They're
Trust but
missing
verify.
that
Yeah.
verification component, right? And I really think that it's important to underwrite as many deals as you can, because that's where the experience and the perspective come in. If you're just going to take someone's word at face value, I mean, most people aren't going to invest in a syndication without really gut checking that pro forma and the prospective.
Yep.
Prospectus. Is that return really what you think? Because it's just a target. And so if you don't really vet out that deal, one, you're not going to create muscle memory on the type of deals that would actually make you feel okay. But two, you might be entering into a loan situation that really isn't well suited for what your risk tolerance is. And so there
Totally.
is a matter of handling risks and rewards. And we handle that in our book very well, because I think it was important to really notate in there what's risks that you have by not doing one of the steps in our CPR lending system, but what also is the reward when you take the time to really do it properly. And
Oh,
so
great.
a lot of that time is like you can't develop muscle memory because no two houses are the same. No two loan requests are the same. No two borrowers are the same. When I get that title commitment back from the title company, no two title reports are the same. So you have to look at a lot of deals to really make sure that you're understanding and putting perspective in. It's like marrying the first guy you date. Like, I don't know that many people would advise it. I think it works well for a lot of people, but it doesn't work well for a lot of people too, right? So you just don't want to be wrong in that scenario,
So
and
true.
be in bed with somebody that you shouldn't be in bed with.
Great, great advice. And I hope you guys all heard that and paid very close attention. Thank you for that. So, my next question, and I'll probably kind of give you a little bit of a debrief, and I didn't spend too much time talking to you about it, Beth, but here in Canada, for those that know, we've had some interesting stories, definitely in 2023 and probably the latter part of 2022, of private lending not going so well. Okay. And this is specifically with some promissory notes that were done on some very big companies, and some of them just did not survive. And unfortunately, we saw some demise of capital and net worth and all of that stuff. So, and a lot of this was done obviously through promissory notes, and there was just not a lot of collateral associated with where to get that. And so they technically declare bankruptcy. And anyway, it's going through a big long story. So, question to you is, what role does collateral play in private lending? And should lenders really be focused on making sure that there's collateral? And how's your feeling, and what's your feeling about promissory notes when you're doing private lending?
100%. We do a promissory note and a deed of trust or a mortgage, depending on what state that the loan is in. We do that with everything. Having collateral to secure your property, real estate is critically important. I cannot stress that enough, because if you're just doing a promissory note, then it's essentially a handshake, right? And then you
That
can't really foreclose on their property. You'd have to go after them, with a civil suit. That can take a lot of time and money. And in the end, you may or may not be successful. I had somebody within my circle that I know peripherally, because clearly they didn't read my book or consult me, but they ended up joining a Facebook group and deciding that after a flip where they made six figures, they wanted to lend 50K to somebody in Canada or California without getting that promissory note and the deed of trust back from the woman in California. They went ahead and wired money directly to the borrower. They didn't have the signed and notarized documents. They certainly weren't recorded. They didn't use a third party closing agent. Some states you can use an attorney. Some states you use an escrow closer, an escrow professional. So I'm not sure how it is in Canada, but you need a third party transaction support
Yep.
because private lending is a team sport. It's not something that you want to just go out and DIY. Well, it turns out that the woman kept telling this friend of a friend that she would pay her back at the sale of her flip. But when you are going to escrow and you don't have that loan recorded against that title, there is
Yeah.
zero obligation to pay that person back. So they got all their cash proceeds from the sale, but the lender got nothing. And now she's in a civil suit to try and collect that money back. I really don't know if there will be any recourse on that. This could be a flip and she rents. And so, in that regard, she may not have the net worth to really be able to go, legally, you wouldn't want to go after her because she's got nothing. A
Yeah.
lot of private lenders are under the impression that if you do what's called a personal guarantee, because a lot of loans are made to business entities to make sure that their business purpose, they think as long as they
Yep.
have that PG that they're safe too. Well, what good is a personal guarantee if you're worth nothing? So that real estate is absolutely critical, not only to make sure that you're protected and with a healthy equity buffer, but also to guarantee that you're going to get paid off when that property is sold or traded, right? Like you need that protection because otherwise you're going to have a heck of a time trying to get that money back.
Yeah, amen. And I think you highlighted this a little bit, and Belky, thanks for sharing this as well. As there's this appeal that, and again, you referenced the whole FOMO effect, especially people who are just getting started. They're just like, oh my God, I got all this money. I needed to do something with this. Oh, you know what? This person is going to be offering me 18, 20% of my money. But look at what the returns can be after and they're doing this calculation. But at the same time, they're doing these promissory notes, still with the anticipation that everything's going to go well. They have not educated themselves very, very well because of the same thought process that they're just really looking at the general number. And it's all about protectionism in case things don't go well. What's your plan B, plan C in some cases? If this deal does not go well, what are you going to do about it? So don't get caught up with the hype. Just make sure you're doing your due diligence and how are you going to protect your money just in case things don't go very, very well. So one of the questions that came up here, and I think you were a little bit alluding to as well. So let's just say that we are doing some collateral, and I know this is going to be a little bit different in the US than it is in Canada, but maybe you can just share some of the legal considerations that should be kept in mind to protect your investment and ensure compliancy. So maybe you can just share some of the rules of engagement, specifically in the US. I know there'll be a lot of commonalities that are here, but maybe just share it from your perspective of what's happening down in the States from a legal perspective with private lending.
Sure. There's a number of things that we do to make sure that we safeguard our lenders' capital. So, like, we not only do, my husband and I lend out our own money, but we lend out money from within our network. It's grown significantly since the time we started. We have about 75 to 80 different investors that lend their money through us, some in the fund and some in whole notes where they're actually on the promissory note, as you mentioned before. Um, there are a lot of documents that we use, legal instruments, to help protect not only the borrower but the lender as well. So there's a promissory note that really lists out all of the terms of the loan itself. That really is the asset that you have when you lend out that money. You lose that original document, it's going to be a little bit harder to be able to execute. So it's important to safeguard that. Then you have that deed of trust or the mortgage against the property itself, depending on what state. I don't know how that operates in Canada, if it's a mortgage or a deed of trust or a different name, but having that security against the property that you record with whatever municipality it is. So in our state, typically it's recorded with the county. And the county will record it against the property, meaning that the property can't go, be sold or anything without paying you back. And so there's the two primary ones, but there's a whole bunch more that we put in there as well. We do a non-owner occupancy certification. I want to ensure upfront that it's business purpose so that I'm not hitting some of those usury issues and making sure that it's business purpose and use because I need to be licensed to do consumer loans in Washington State, but I don't need to be licensed to do business purpose loans. So that's important for us. I want to make sure that I have a business strategy letter detailing out in writing what their loan request is, what the property project details are. Tell me how much your estimated rehab budget is, all this stuff, and they sign the bottom of it. I really want to make sure that we're aware that it's business purpose all the way. We also get what's called a lender's title policy that guarantees our position on title. So if I were to go into first position, like the property is owned free and clear, I want to get the assurance from the title company that I'm going to be placed it's securely against the property in first lien position,
in first.
and that if
Yeah.
there were any sort of issues with that vesting, that I'm protected. That's what the lender policy protects me on, and I have had to execute that a couple times before. An additional piece that we always ensure for our lenders is to make sure that we get the lender, whether it's us and our fund or whether it's our lender, we get them added as a mortgagee or a loss payee on the hazard insurance policy. This is critically important because if that property goes up in flames and you're not listed on there, a check is going to be cut to the borrower, not you. And I actually funded a deal. Gosh, I think it was right before COVID. We funded it the first week in November, actually, and 2 weeks later, squatters came on and torched the place. If I had not had my lender on there as a mortgagee, they would not have received any of the proceeds from that insurance claim. And in this particular instance, the land value wasn't enough to cover them. And so it
Wow.
really would have been hard for them to recoup their principal without having been placed as a mortgagee on that hazard insurance policy. So that's something else that we do as well. And then outside of the paperwork, there's a handful of other things, closing disclosures, business use affidavit, where I have them write in handwriting, what their intended use is. We also make sure that we have a virtual team around us to really help protect the loan before it gets funded. So I think I mentioned a few before. I have a third party closing agent that transacts that loan. Usually, like if we're doing an acquisition and we're doing the financing for an acquisition, then that closing agent that helps transfer title from the seller to the borrower would help facilitate our loan signing, the notarization, the recording with the county. But I also use other resources. I think a real estate attorney who is adept at private money loans, because that's not always the case, is absolutely 100% critical. I have seen real
Totally.
estate attorneys draft up promissory notes that have come across my desk. Thank God they weren't my client, but it didn't even have an interest rate. That's not enforceable in Washington State. I would imagine that's not enforceable in a lot of places, but
Correct.
particularly in this state, it isn't. And even though he's an experienced real estate attorney, I don't know what the rationale was behind that. They ended up having to go after the borrower in a civil suit instead. Took her close to 10 months. And the only reason it took that little amount of time, I should say, is because the borrower actually didn't show up to court. So there was a summary judgment against her. But, you really have to work with a real estate attorney that can advise you, share with you what the legalities are, make sure that you have the appropriate documentation to back it up, because that is your asset, 100%. And then making sure a third party transacts it for you so that you can make sure that it's handled cleanly and that funds aren't dispersed until everything is properly vetted, signed, reviewed, and signed off.
Amazing answer. Bang on the money for sure. Make sure you've got the right team member as part of your legal team for sure, especially in the space that you're investing
Yes.
in. So great stuff. Great stuff. There's a question that came up from Maria here. And it's actually one of my questions, of course, right, too. But it's, maybe you can discuss how private lenders can maybe handle default and delinquencies effectively. Have you ever had a situation where a borrower has default in payments, and what were the steps to maybe resolve it? I guess part of it is resolution of payments, and secondly is maybe delinquency to default. I guess what were some of the things? Have you had that experience? And maybe you could just share a little bit about your story in there, because everybody loves stories. Everybody wants to hear
Yes.
a real story. So
I
I'm
could be
sure in your
what not to
experience you got
do.
one, right? You got maybe
Yeah.
one, right? So
Okay, so first, I will say I have not had that much experience in, thank goodness, right? Our default rate is sub 3%. I've never suffered a principal loss, thank goodness, knock on wood. But it's because we structured it properly up front. And so I can't stress enough that that's the most important thing, is to ensure that you're doing things effectively and safely before you lend out your money so that you don't have to deal with it afterwards. That said, you know, one thing that we make sure that ensures our payments are handled on time is we work with a third-party servicer that helps service our loans. They take the payment directly from the borrower's account because they'll authorize to have an ACH debit every single month on the first, and then they will get my bank account information and they will do an ACH credit every single month. They hold it for 5 days or however long the loan servicer wants to hold it for. If there's any NSFs, then they will work with the borrower and send them notice to make sure that they can remedy it. I will be notified as well. So that if I want to take matters into my own hand, I can do so as well. But I'll say, once you put that with a third party servicer and you do automated deposits and withdrawals, so you don't have to deal with checks being sent to you in the mail, which is how I started, you have a much high degree of likelihood that the payment's going to be made on time. So that's something that preemptively and proactively that you can do. But
Right.
once a loan does, maybe it's delinquent, usually it's just a matter of calling them and letting them know that they're delinquent. I think that it's not a surprise to any of you probably that delinquencies across the board, conventional, commercial, hard money, private money, they've gone up, right? Times are
Hmm.
tough. Credit's tight, cash is tight, transaction volume has dropped significantly. I think the most I've had was just a couple months ago in the summer. We had 12 in 1 month, which is a lot for us. Well, we just started dialing for dollars and calling all of them. And wouldn't you know, within a week or two, they were all remedied. That said, it doesn't always happen, right? So some will go dark or they'll make promises and they won't take care of it. Then you go into, from delinquency, you go into what would be called a default. Now, default sounds scary. There are always going to be or should be provisions in your promissory note that detail out what happens in a default scenario. I've seen a lot of promissory notes that say, okay, we're going to charge you 10% a month. And there's nothing in there that states what happens when they don't perform. That's the
Mm.
worst case scenario because if I don't have a maturity date on there, if I don't have default penalty in there somewhere, what is the incentive of the borrower to pay you back? There really is none. And so you need to make sure that you establish a default penalty or default interest rate that kicks in. Again, you have a healthy equity buffer, 70% loan to value or better. And so you have this 30% protecting you so that even if I charge 18 or 24% default interest, which is pretty standard in the hard money and private lending space down here in the States, that can help be covered through the equity protection that I have against the property itself. So then I'm just trying to do some workouts with the borrower. Um, is it kind of scary? Yeah, I mean, you don't have to do it very often, so it really sucks to think that you might have to go into some sort of legal battle with somebody. But again, if you
Mm.
have that large equity protection in there, 9 out of 10 times that borrower is not going to default to the point where it goes to auction. Why?
Yeah,
They have too much equity in there. They have too much at
totally.
risk. And so
Yeah.
there's too many other ways to exit out of that loan than to let it just go to auction and somehow they may lose that surplus of funds because they just let this drag out month after month, garnering 18 to 24% default interest. So while the foreclosure can be a worst case scenario, or the nuclear option, as my co-author likes to say, it doesn't always have to end bad. I actually wrote a blog post for Bigger Pockets last year detailing out what happens when loans go wild. And it was actually one of my clients. He was in first position on a property, gorgeous property outside of Seattle. There's about 65% loan to value in there. The seller actually carried back some of the purchase price in second position. They had a personal relationship with her. They'd already lease optioned it to her and they felt comfortable carrying back in second. But my client went in first position for $370,000. And when the second month she defaults, we try to reach out to her. It's a lot of chatter. And so fast forward, I think it was maybe 10 months because in our state, best case scenario for a foreclosure is around 5 months. In some states like Texas, you could get it done in like 30 days, but it really
Mm.
varies by state down here. By the time we actually finished it out after her filing some fraudulent bankruptcy filings twice to stall, and both of them were dropped, we were able to take back control of that property at auction. Ironically enough, nobody actually bought it at auction. I don't know why. It was, like I said, it was on the river. It's really pretty. Had been updated. But there was still a lot of equity in it. And my husband and I went and found 5 different investors that were looking for a wholesale deal. So they would have taken that property off my client's hand instantly. But my client, knowing that he had, cash flowing rentals and he was retired in his 50s, he was kind of bored and he had done real estate before. So he decided, I'm going to flip this property myself. So he went ahead and flipped it. And in the end, he was able to sell it for, I think, the mid sevens. So
Wow.
all in for his interest, default interest, late fees, and then the flip proceeds, he was able to make about $150,000 on it, something like that. I wrote the blog post a while ago, but it's called Loans Gone Wild, and it details out what can actually happen if you safeguard the loan properly. That even if it hits that default scenario, it really can be an okay situation in the end. You're actually going to still come out ahead. So, but it'll take a little bit of time for sure.
Yep. Perfect. Perfect. And I think there's a segue or a second part to that question that just popped up from Christina. And I guess it was specifically for penalty costs. So what are appropriate penalties for promissory notes that are delinquent and were signed for shorter terms, such as a 3 to 6 months at 18%? Obviously, the rates may be slightly different in the US and stuff like that, Beth. But maybe you can just share your experience and what are you guys charging for penalty costs, just because it could slightly vary here. So,
Sure. We typically have a clause in there that the default interest rate is 24%. I always like to use it as a carrot rather than a stick, to be honest with you, because I just don't want it to get to that non-performing state. But it does
yeah,
give me some of the clout to be able to go back to him and say, hey, look, you got to do something. And if you can get this done by the end of the month and get us current, great. Or if it's past maturity, like, hey, if you can pay us off by the end of the month, I'll reduce my default rate to 18% or to 14 overall. We've negotiated that quite a few times. So I like to have it in there to be able to negotiate. To your point, you have to be really familiar with what you're allowed to charge. There have been a lot of notes that I've seen in the past where they had what was called a 3% balloon payment penalty. So if it passed
mm,
maturity, then you could charge 3%, but they were also charging default interest at 18%. Now, that's legal for all intents and purposes in Washington state, so long as those fees go to the lender. But experience tells me, from having conversations with my foreclosure attorney, that's not very, it's kind of frowned upon by the courts. And
yeah,
so they do this day in and day out. They know what passes and what doesn't.
yeah,
And so you really have to charge one or the other. So in the cases where we in the past have had both, we have waived one so that there was default interest and we just got rid of the balloon payment penalty. We really couldn't go after both. So it really is a matter of working with local attorneys that are actually experienced in the foreclosure process that can tell you what you should do, what's legally allowable, and what's realistically enforceable in courts. Because the last thing you want is to have it in there and you just can't recoup what you put into it. And in Washington, it's a little bit more of a blue state, it's a little bit more progressive. So what I can get away with here is probably significantly less than if I go to a state like Texas, which is a bit like the wild, wild west. And if you go to California, you can enforce even less. It's a lot more restrictive there and a few other states as well. So it's a matter of just knowing what you're allowed to do legally at the Fed level.
yeah. Same thing, guys, here in Canada. So just make sure
Mm.
when you, and again, Beth highlighted this, you want to make sure you've got a good lawyer that understands this business quite well and all the rules of engagement that comes along with this. You want people that have got experience that are doing this like the back of their hand in a lot of ways, so they can understand some of the rules as it comes to your deal as well. And to your point is, if it gets to that point where it's going to the courts, you know what, there'll be specific limitations on how much they're going to charge for a penalty if it ever gets to that state for sure. So,
Yeah,
um,
well, let me just say that that's not the time to get cheap, right? Like, I
totally,
see a lot of
yeah,
people saying, like, can you Google legal documents? Yeah, you can, or you can go to like NOLA or whatever those sites are, Legal Zoom. It's like you can get something for cheap, a template, but will it protect you in your particular situation, in your particular market? Maybe, maybe not. But it's a lot more expensive if you have to engage legal resources after the fact. So why don't you just pony up and pay, a grand, $1,500, whatever it might be, to have those legal documents prepared by a true legal, professional.
Yeah, legal documents, guys, don't cheap out on this, especially in this game, for sure. So, okay. Um, Beth, just amazing stuff. Like, thank you so very much. This is just awesome. Top of the hour here. Just one last question. I always like to ask our guest speakers. This is just final words of wisdom, and I'm going to talk to it in two fronts. So hopefully, it's not going to be too long. But at the end of the day, we can take as much time as you need. But for maybe final words of wisdom for those that are getting started and are considering private lending. For kind of their first real estate venture for themselves. And secondly, for those that are maybe in the private lending space right now that are maybe struggling at this point in time with maybe some challenges with some of their private lends. So maybe you could just share quickly a couple words of wisdom for both sides of this, because I know for a fact we have both of them in this live today. So
So for new and aspiring private lenders, I would say really understand your why. We devote an entire chapter in our book. It was very important to me because, like I said, it started off as a side hustle. Now I'm funding 50, $60 million, and it's a complete active business. When it was
yeah,
supposed to give me freedom to be able to go and pick up my kids from school and drop them off, I'm running a business where before I was part-time. So we have an entire chapter devoted to calculate and evaluate, and all of that is really predicated on understanding what your professional, your personal, your financial goals are, really establishing a framework up front and taking the time to understand how much capital do you really have to lend. I mean, just because you have 50 to 100K doesn't mean you should lend it all out. You might need to
totally.
keep some aside so that you can pay for legal fees. You might, if you're lending out borrowed money and arbitraging, which I've seen some sophisticated investors doing that as well, you need to make sure that you can keep some aside that if you have a missed payment, you can make your HELOC payment. There are a lot of things to consider and that you should do before you actually start funding, and that you have a real true solid of understanding of why you're doing it. Because most people get into private money purely as a passive investment, and it very quickly can get out of control because didn't really put in a whole lot of time on the front end to make sure that you were designing this program to fit your personal needs and your personal lifestyle goals. Um, and then, so the second one was around existing investors that lend out their money and how to maybe shore up some of their, I'd say just get connected with the community. I have a community on Facebook called Lend to Live, a private lender community or a collaborative. I think that the best way to be able to learn, although the book is great and very comprehensive, like you said, you need to know stories. You need to know what not to do. You need to hear somebody else's different perspective. My husband is on the front end on sales. He's finding every reason to say yes to a deal. I'm on the underwriting and the backside. I am finding every reason to say no. And I will guarantee you that if I find every reason to say no and we still want to fund it, it's pretty solid, right? Like chances are we've covered every possible scenario. So get connected
Good.
with other real estate professionals. It doesn't just have to be private lenders, but real estate agent friends, mortgage professional friends, appraisers. I have an insurance friend on hand. I have a review my clients' insurance policies all the time to make sure I have proper coverage to protect my loan amount. And so it really is kind of creating that network so you're not doing it solo, you're not doing it alone, because that can be one of the scariest things out there.
I agree. Like the amount of calls I get and messages and people that are reaching out is, hey, before I'm looking at doing this private lend, Mike, do you want to just take a look at this deal quickly just to see if this is truly viable or not? It's quite significant, right? It's important to get that information before you take your good money, your good hard earned money that you've made to invest in something that, you may or may not know is a good deal or not. So take the time. Like you said, Beth, get part of your community. Obviously, you guys are all part of Savvy Investor. Make sure you reach out to Beth's community as well. It'd be great. So amazing stuff. Beth, thank you again so much for sharing such great information, which I'm sure everybody just got a ton out of it. I'm just see some of the messages and notes right now. But if people want to learn more about you, follow your investing journey. So there's two things: is what's your tag on your Instagram, so maybe people can kind of follow you. Number one, and then secondly, just the name of the book again.
The name of the book is Lend to Live, Earn Hassle-Free Passive Income in Real Estate with Private Money Lending. Right here behind me, show you.
Cool.
It's available on Bigger Pockets. It's also on Amazon, but I would say buy it on Bigger Pockets just because there's a few extra bonus materials. We have a lot of supplemental materials in there, including templates to use, which is really great. And you can follow me on Instagram at lend2live.beth, and it's lend the number 2 live.beth.
Awesome. You know what I'm going to do for you guys? I'm going to put the link for the book through Bigger Pockets, and secondly, a direct link to Beth's Instagram page as well. So make sure you give her a follow. Definitely read the book. It sounds like a really great resource to help support you guys in your private lending venture. So Beth, again, thank you so much for sharing your wisdom with the Savvy Investor community. I really, really appreciate it.
Thanks for having me. It's been great.
Great. So as we kind of just wrap things up, guys, I want to thank everybody that was able to join us live in the training session. Again, I hope you guys all found a lot of value as much as I did. Do me a small favor if you have not done so already, hit that subscribe button again. Hit that notification bell just to keep you informed of upcoming videos, as we've got a lot stacked up for this coming year to help support you. And again, regardless if you're watching this live or through the recording, post your questions and your comments below for myself. And even for Beth, I'll forward those questions over to her if need be, to make sure we get a timely response accordingly. So again, thank you everybody for joining us, and we look forward to seeing you at our next YouTube Live. Cheers.